Good morning, everyone, and welcome to the Ankerstar Wealth Market Update. I'm your host, Allison Ankerstar, and today we'll be talking about the upcoming week full of bank earnings, the just announced 10-for-1 split in Shopify shares, and what's going on with Nvidia stock. But before we begin, as a reminder, this is a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. Several of the major banks kick off earnings week this week. What do you expect?
Hey, good morning, Allison. Thank you for that intro. So yeah, earnings week for the banks this week. So you can see the futures are down big. We'll get back to those here in a second. But, everything's down about a percentage point. A lot of negativity in the air. Interest rates are rising. So what can save us this week? Well, let me tell you. Scroll down to the bottom of this article, and that's what I wanted to show you. And it's what Allison asked about, is on Wednesday, you have JP Morgan and Delta start off earnings season. And then you have Citigroup, Goldman, Morgan Stanley, and Wells Fargo on Thursday. So really, what do I expect this week? I expect some pain, right? I don't see any particular good news coming out of this week unless you would get a ceasefire or a significant drawdown in Ukraine-Russia situation. But negativity from the weekend, inflation out of control. The Fed's not doing enough but it's 3 weeks till the next meeting. So there's really nothing, there's going to be no new news there, if you will. So really, I think it's negative for a couple of days, and then maybe we get a good number out of JP Morgan. Overall, when you talk the financials, I use the XLF as exposure to all the financials. If you want the whole slice of everything, this is a 1-year chart. 41 was the high back in, the highs we had at the end of the year. And then, down to 37 or so. So, it's at 10%. 10% down isn't really that bad considering the market environment we've had, right? And banks are supposed to do well when interest rates rise because of net interest margin. So it only makes sense that banks start doing well under this environment and that they would start to recover. However, I like the individual play if you can find one. And I do think JP Morgan is best of breed in this category. Here's that same 1-year chart. And the stocks, from highs at around 170 down to 135. So quick math tells me, that's like 20-some% down. Maybe there's a year-to-date number here, down 15% year-to-date. So, I think it's a lot better entry point. And of course, you have JP Morgan, the investment banking side, and then you have Chase, which is the consumer side, the retail side, and you have one of the best CEOs out there, even though he had kind of a dire outlook the other day. So I think that's scaring folks out of the banks. I think once we see the earnings, though, you could see things turn around. Overall valuation, PE of 8 for JP Morgan and a 3% dividend. I mean, this is a buy. You can put this away and just kind of hold on to it for the long term, and it's going to make you money, in my opinion.
Next, Shopify just announced 1 10-for-1 split. Is ticker SHOP a buy-seller hold?
Well, I'm not a huge fan of Shopify stock just because I think there's too much competition in the space, and the stock's kind of, it's been all over the map, if you will. So they plan a 10-for-1 stock split. So am I positive on stock splits? Absolutely. Do I think it's going to be a great thing for Google and Amazon, just like it was for Tesla and Apple, the 100,000 times that Apple split? Yes, I do. However, the underlying, the horse jockey thing is not as clear cut in this case. Obviously, Shopify is not going anywhere. There's just so many competitors. When you look at their stock, down 50% year to date. Okay, that's not a sign of strength. I mean, Google and Amazon were down like 15%, not 50% year to date. So this isn't really a move of strength, I don't think. And you also, I think it's more gimmicky, if you will, or financial engineering. And also, I'm looking for it in here, the founder share to protect CEOs' voting power. Okay. If there's stuff that scares people in the world, and it should, it's BS like founder shares. Now, I call it BS just because there's no need for it. I mean, Under Armour started this crap with 2 tickers, right? UA and UAA, and one of them is Class A, the other one's Class C, and blah, 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 blah. It's all crap, right? Why are we running 2 tickers for Under Armour? Why are we running 2 tickers for Google? Same thing. So whenever you have companies that come out with these different share classes, it's unnecessarily complex. And when there's unnecessary complexity going on, you have to wonder what's going on behind the hood, right? Or under the hood. So I don't like it. I'm not going to rush into this name at all. It is down a lot. I don't necessarily consider it best of breed. The split will probably help. We'll take a look at the ticker just real quick so you can kind of see the action on it. I do have it in the book. I have some folks that love it, swear by it, use it. I don't share that opinion. I'm more than happy to be wrong if this thing comes screaming back. But, it was up here at 1700 almost, down to 612. What's that, down year to date, 56%. Just not for me, not going to follow the gimmick. So I would say if you have it, hold it, but I'm not looking to buy anytime soon here.
Last, what do you think of Nvidia's request to double the number of outstanding shares?
Well, we talked about gimmicks and financial engineering and founder shares. And the one thing I just really don't like out there is financial engineering. So here you have, now this is unverified. I mean, it's on CNBC, but they're down 3% this morning following an announcement that the semiconductor firm would seek shareholder approval to double the number of authorized shares. This would give the Nvidia the flexibility to take actions like stock splits and issuing equity incentives without a further shareholder vote. I got to give this a buy, Felicia, right? I can't support this. I can't be in this name. So when you think of a company out there and the number of shares, there's the company value and you divide it by the number of shares. And that's the fraction that you own. So Allison, if you own 1 share of Nvidia, you own 4 millionth or whatever the fraction works out to be of this company. If they issue another 4 million shares, your exact ownership of that company just got chopped in half. So they're going to their shareholders right now to say, I would like to give you the opportunity to cut your value in the company by half. I would like to drop it 50%. No thanks. I think the shareholders should revolt against this. I don't know. I think a lot of shareholders are just asleep and say, well, whatever the company needs to do. But they want the flexibility to do a stock split, a little bit financial engineering-y there, and then issuing equity incentives. So they want to be able to pay more without, taking to a shareholder vote. So I don't know. Anybody watch Roblox and the CEO just get that ridiculous $230 million pay package? I don't know. What's going on here? Are we doing right by shareholders? Are we doing right by consumers? Or are we making ourselves rich through financial engineering? I love Nvidia, the firm. They got a downgrade this morning. Even them asking this question shows that there's not the level of maturity that I want out of corporate leadership. So I'm going to be out of Nvidia today.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar, and we'll see you back here tomorrow.